Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, we are from Group 6 and this is our presentation for Income Tax for Corporation and Fiscal Reconciliation material. The members of Group 6 are Mefa Alya, Vania Azalia Calista, Fadilla Yonandes, and Devi Yulia Sari. The topics that we will cover in this presentation are corporate tax, fiscal reconciliation, trade-off accounting tax, differences, non-tax object, and non-deductible expensive and subject to income final tax.
So the first topic that we will talk about is corporate tax. For tax on company income, it is paid directly by the company, and it consists of tax installment, as it mentioned in Article 25, and tax at the end of the year, as it mentioned in Article 28 and Article 29, and taxes withheld by other party. It is part of final, not final, Article 22 and 23, and disclosed in the income statement so that it affects the amount of tax expense, as well as in the statement of financial position. For withholding tax, the tax on income received by other parties, as mentioned in Article 21, 23, and 26. And value-added tax on the delivery of taxable goods or services, and disclosed in the statement of financial position as tax payable or prepaid taxes, but does not affect in the income statement.
And for corporate tax, the other taxes, there are value-added tax that is typically due on event involving the transfer of taxable goods or the provision of taxable services in the Indonesian custom area. And then there is luxury goods sales tax that is in addition to VAT, deliveries or import of certain manufactured taxable goods that is subject as a luxury good. And then there are property tax or PBB. There are acquisition or duty of right on land and building or bea pengalihan hak atas tanah dan bangunan. There is local tax, and finally there is stamp duty or bea materai.
My name is Devi Sari and I'm gonna explain about installment of corporate tax. So first, the company must pay taxes every month, and installment are calculated from the previous year's tax, or for new companies there is a method of calculating itself, and installment of tax will be recorded as tax prepayments and will be calculated in year-end taxes. Example is in the bid prepaid taxes with PPh 25 is 2 million and in the credit cash 2 million.
Well, hello everyone, my name is Fadilla Yonandes. In this chance, I want to explain about corporate tax withholding by other parties. First, we should know about the final tax. Final tax is not be calculated as a tax credit and the income is not included in the SPT. Usually it is not included in the recording, so the income will be recorded at the time after tax value. And for deposit interest of income, it is usually included immediately after tax. And second is non-final tax. Withholding tax is included as a tax credit, and the income is included in the tax return. Taxes paid are recorded as prepaid taxes. For example, gas is about 940,000 in debit. Prepaid taxes PPH number 23 is about 60,000 in debit, and also rent revenue is about 1 billion in credit.
So this is the nature of fiscal reconciliation. The first one is bookkeeping based on company accounting policies and deviates from tax regulation. And the second one is differences arise in the recognition of income and expenses in the income statement. And the third one is an adjustment is necessary so that profit that is calculated on an accounting basis can be treated as profit or taxable income.
Okay, so for the fiscal reconciliation techniques, the first one is if an income is recognized in accounting but not recognized on a tax basis, reconciliation is made by deducting that amount of income from accounting income, which means reducing accounting profit. And then, if an income is not recognized in accounting but is recognized in a fiscal basis, the reconciliation is made by adding the amount of that income to accounting income, which means increasing accounting profits. And if an expense is recognized in accounting but is not recognized as a deduction from gross income under the fiscal terms, the reconciliation is carried out by subtracting the amount of expenses. So it will increase the profit according to accounting. And the last one, if an expense is not recognized in accounting but is recognized as a tax deduction from gross income, the reconciliation is carried out by adding the amount of the expense to the cost accounting. To the cost according to accounting, which means it will reduce the profit according to accounting.
Next is threat of accounting taxation. On the accounting side, it is profitable because it will attract potential shareholder and public companies will prioritize this interest. And for the tax side, it is not profitable because incurs the tax expense must be paid. So we have to know if we work in tax consultant, auditors in every company have a threat of between accounting and taxation. High profits will be accompanied by paying a big tax. If we don't want the tax not big, then the profit is not big anyway. So if we pay lower taxes, then the income will be low and the performance is bad. And for public companies, it becomes a concern because the company continues to optimize profit despite the consequence of paying taxes. But for a closed and reclusive company, it is often the case to report large income to the bank, but on the tax report reported in small income as long as he pays a small tax. It is a practice that's not all of it or not ethical.
Background of differences. Counting and taxation are determined by different authorities and for different purposes. The difference between accounting and tax doesn't only occurs in Indonesia but also occurs in other countries. Tax research related to the book tax gap as follows. First, what causes book tax gap? What is the consequences of the book tax gap? For example, the consequences such as earning persistence, return persistence, information value from book tax gap, and can book tax gap be considered as a tool for earning management?
This is the framework of differences. As you know, fiscal reconciliation happen because there are some differences which can be divided into two types, permanent and temporary. And this also being a focus on a research called book tax gap. And in accounting side, it will show a deferred tax.
In general, there are two differences in recognition of both income and expenses between commercial accounting and fiscal or in taxation that cause fiscal correction or reconciliation. The first one is permanent differences or beda tetap. Permanent differences is the difference in recognition of both income and expenses between commercial accounting and the provision of the income tax law, which are permanent in nature, meaning that the fiscal correction made will not be taken into account with the taxable profit of the following tax year. This can happen in two cases. The first one is in the recognition of income. In the case of recognition of income, correction due to differences will occur because, according to commercial accounting, it is income, whereas according to the income tax law, it is not an income. For example, dividends or a share of profit received or obtained by a limited liability company as a domestic taxpayer from capital participation in a business entity that is established and domiciled in Indonesia, with the condition that dividends come from retained earning reserve and share ownership in an entity that provides a dividend of at least 25%. According to commercial accounting, it is income, while according to the income tax law, final income tax has been imposed. And in the case of recognition of costs or expenses, due to differences, they will occur because according to commercial accounting, they are costs, whereas according to the income tax law, they are not costs that can reduce gross income. For example, costs to earn, collect, and maintain income, who are not subject to tax, whose tax imposition is final, and whose compensation or remuneration in connection with work or services rendered in kind and in kind. Correction of a fixed differences in income will cause a negative correction, meaning that the income recognized by commercial accounting but fiscal must be corrected either because it is not a tax object or because it has been subject to final income tax. This will cause taxable profit to be reduced, which in turn will cause the income tax payable to be more small. And for the correction of fixed cost differences will cause a positive correction, meaning that the costs are recognized by commercial accounting that must be corrected in fiscal term, will cause taxable profit to increase, which in turn will cause the income tax payable to be higher. And the next is timing differences or beda waktu. Time differences is the difference in recognition of both income and expenses, which are temporary in nature, meaning that the fiscal correction made will be calculated with the taxable profit of the following tax year. And it can happen in the case of the first one is recognition of income due to time differences. In the case of recognition of income, correction due to time differences will occur because receipt of cash basis income for more than 1 year. In commercial accounting, the income must be allocated according to the period of its acquisition, in accordance with the principle of matching cost with revenue. Meanwhile, according to the income tax law, the income must be recognized at the same time when it is received. And for in the case of recognition of costs or expenses, the correction due to time differences can happen because of the first one, differences in the depreciation method, where according to income tax law, only depreciation method allowed was a straight line method, and the balance is decreasing. And next, different methods of inventory valuation, where according to the tax law, the only allowable methods of inventory valuation are the average and FIFO method. And last one, because of the allowance for uncollectible accounts, wherein according to tax law, allowance for uncollectible account is not allowed except for certain business. Correction of differences in timing of income will cause positive correction where income is received and will cause negative correction in subsequent years. This positive correction will cause taxable profit to increase, while negative correction in subsequent years will cause taxable profit to decrease. Correction to time difference in cost can lead to a positive or negative correction depending on the method used.
How to step different adjustment in reconciliation. Start with accounting profit. Next is add unrecognized income. Example, unearned income. According to tax is income, but according to accounting is not. And next is non-taxable income. Example, income from subsidiaries, and this will be deductible. Further, add non-deductible expense or fees according to tax which is not allowed. Example, expense that are nominative. Next, less deductible costs that have not been charged. There is no tax according to the cost tax to be deducted, but according to accounting is not. And then next, less income subject to final income tax. All final taxes must be issued from SPT. Example, dividend, deposit interest, the distribution of the taxation from the capital market. And the end, 3 and final income expense, and thus deductible taxable income or PKP, from which from there we multiply the rate from here to get the current tax expense. And the final step, we record the different tax of the difference that are temporary. So in the general, the flow is like this.
Non-tax object based on the PPH Article 4, Paragraph 3, first, aids or donation, including zakat received by Amil Zakat Board or other Amil Zakat institution, established or approved by the government and received by eligible zakat recipients, or compulsory religious donation for the followers of religions acknowledged by the government and received by a religious institution established and approved by the government, and received by eligible donation recipients, which are stipulated by or based on a government regulation. Next is gift received by a relative within 1 degree of direct lineage, and to religious body, educational or other social entity including foundation, cooperative, or to any individual who conducting micro and small business which stipulated by or based on a Minister of Finance regulation.
Next, inheritance. And after that, assets including cash received by an entity referred to in Article 2, Paragraph 1, Subparagraph B. And after that, consideration or remuneration in the form of benefits in kinds in respect of employment or services received, or accrued from a taxpayer or government, except given by a non-taxpayer, taxpayer which is imposed by final tax or taxpayer using deemed profit as referred to in the Article 15. And next, payments by an insurance company to an individual in connection with health, accident, life, or education insurance.
And the next for non-tax object is dividends or distribution of profit received by or accrued by a resident limited corporation, cooperative, state-owned enterprises, or local government-owned enterprises through ownership in enterprise established and domiciled in Indonesia, provided that 1. Dividends are paid out from retained earnings, and 2. Limited corporation and state-owned enterprises and local-owned enterprises receiving the dividends must own at least 25% of the total paid-in capital. And the next point is contributions received or accrued by a pension fund which its establishment is approved by the Minister of Finance, either paid by an employer or an employee.
I. Income from a capital investment of the pension fund as referred to in subparagraph in certain sector as determined by the Minister of Finance decree. J. Distribution of profit received or accrued by a member of a limited partnership whose capital doesn't consist of share partnership, association, firma, and kongsi, including a unit holder of collective investment contract. K. Income received or accrued by a venture capital company in the form of profit distribution of a joint venture company established and conducting business or engaged in activities in Indonesia, provide that first, the investee is a micro, small, medium-sized enterprise or engaged in activities in business sector stipulated by or based on the Minister of Finance regulation, and the second, the investee's shares are not traded in the stock exchange in Indonesia.
Next, scholarship that fulfill certain requirements which are stipulated by or based on the Minister of Finance regulation. Next, a surplus received or accrued by an institution or a non-profit organization engaged in education or research and development, which has been listed in corresponding institution, which is reinvested in the forms of infrastructures of education and research and development, within no more than 4 years period of time since it is received or accrued, as stipulated by or based on the Minister of Finance regulation. And last is about aids or donation paid by the Social Security Agency to a certain taxpayer, as stipulated by or based on the Minister of Finance regulation.
Non-deductible expenses based on Article 9, Paragraph 1 of the Income Tax Law. In determining the taxable income of a resident taxpayer and a permanent establishment, the following are not deductible. A. Distribution of profit in whatever name or form. B. Expenses charged or incurred for the personal benefit of shareholders, partners, or members. C. Formation or accumulation of reserves, except first, reserves for bad debt of a bank and other businesses which conduct business as a creditor, financial lease company, consumer finance company, and factoring company. 2. Reserves in an insurance business including reserve for social aid made by Social Security Agency. 3. Guarantee reserve for deposit guarantor institution. 4. Reserves for cost of reclamation in general mining. 5. Reserve for cost of reforestation in forestry business. And 6. Reserve for closing and maintaining industrial waste site conducted by industrial waste processing business.
And next, for non-deductible expenses, there are insurance premiums for health, accident, life, dual purpose, and education insurance, which are paid by an individual taxpayer, except those paid by an employer, where premium is treated as income of the taxpayer. And next, consideration or remuneration related to employment or services given in the form of a benefit in kind, or consideration or remuneration given in the form of a benefit in kind in certain regions and in connection with employment, as stipulated by the Minister of Finance regulation. And next is excessive compensation paid to shareholders or other associated parties as consideration for work performed. And next, assets granted, assistance, or donation other than donation determined as deductible expenses and other than mandatory religious contribution to institution established or authorized by the government. And last is income tax.
Non-deductible expenditure, Artikel 6, Paragraph 1 Undang-Undang PPH. I. Costs incurred for the personal benefit of a taxpayer or his dependents. J. Salary paid to a member of an association, firm, or limited partnership the capital of which doesn't consist of stock. K. Administrative penalty in the form of interest, fines, and surcharges, as well as criminal penalty in the form of fines imposed pursuant to the tax laws.
Other non-deductible expenses. First, non-deductible, such as free medical treatments for employees, lunch for partial employees. Income tax 21st is financed by the company, and the meal fees without a nominative list. And next is deductible. First, reimbursement of medical expenses, lunch for all employees, tax allowance of PPH number 21st, and meal fees include a nominative list.
Income subject to final income tax based on Article 4, Paragraph 2 of the Income Tax Law. The first one, income in the form of interest from deposit and other savings, interest bonds and state bonds, interest paid by cooperative to its individual members. And second, income in the form of lottery prizes. Third, income from a transaction of shares and other securities, derivative transactions traded in exchange, and sales of share or transfer of capital contribution from its company partner received by a venture capital company. D. Income from transfer of property such as land or building, construction services business, real estate business, and renting land and or building. And the last one, other certain incomes. This is the end of our presentation. Do not hesitate to give us your suggestion and question. Thank you for your attention. Have a nice day.